Have you ever wondered how Sharia banking navigates the intricate world of finance without interest rates? Or perhaps how asset liability management techniques come into play in this unique banking system? If so, you're in for a treat. Sharia banking, also known as Islamic banking, operates on principles derived from the Islamic law, Sharia. One of the fundamental principles of this system is the prohibition of interest, or riba. This might seem counterintuitive in a world where banking and interest seem inseparable. However, Sharia banking has devised innovative ways to create a profitable, ethical, and sustainable banking system. Instead of interest, Sharia banking operates on profit and loss sharing. In a nutshell, the bank and its customers share the risk of any financial venture. This principle is known as mudaraba. So, instead of lending money and charging interest, Islamic banks make investments in businesses and share the profits or losses. Now, you might be wondering, how does Sharia banking manage its assets and liabilities without the conventional tools of interest rates? This is where asset liability management techniques come into play. Asset liability management, or ALM, is a strategic approach to managing financial risks associated with changes in interest rates, liquidity, and the maturity of assets and liabilities. In the context of Sharia banking, this involves managing the risk of the bank's investments, which replace the role of interest-bearing loans in conventional banking. Sharia banks use various techniques to manage these risks. For instance, they carefully select investments based on their risk profile and expected returns. They also diversify their investment portfolio to spread the risk. Moreover, they use hedging techniques like forward contracts and swaps to manage potential losses. However, these techniques need to align with the principles of Sharia law. For example, investments must be in halal or permissible businesses. Also, hedging techniques must not involve speculation or gambling, known as gharar and maisir in Sharia law. In essence, Sharia banking offers a unique approach to banking that intertwines financial sustainability with ethical principles. It uses innovative asset liability management techniques to manage the risk of its investments, ensuring profitability while adhering to the tenets of Sharia law. To recap, Sharia banking operates on the principles of profit and loss sharing, avoiding interest, or riba. This system uses asset liability management techniques to manage the risks associated with its investments, ensuring the bank's profitability and sustainability. These techniques, however, must align with the ethical principles of Sharia law, adding another layer of complexity to this unique banking system. So, the next time you hear about Sharia banking, remember it's not just a banking system. It's a holistic approach to finance that combines profitability with ethics, paving the way for a more sustainable and equitable financial world.